Hey, Courtney Smith here with what you've been waiting for all week. That's right, the TradeSmith video newsletter. Let's dive right in. And first of all, the most important part of this whole presentation is this disclaimer. So read it, memorize it, understand it. All right, listen, I really think this is getting very, very interesting. So here's the S&P, and there's a couple things here. First of all, this market's going to sell off this week. That's almost certain. A couple of reasons. We're at the top end of what is really a rectangle formation, although technically it's a very weak megaphone formation. And basically we're up at the top, so we should trade down towards the bottom. Now, the other thing is that you can see that there was some divergence here with the RSI. That's the two red arrows. We made a new high on the S&P a few days ago, but we did not make a new high on the RSI, and we've already sold off. And I think we'll probably sell off pretty much this whole week in the stock market for those two reasons. Let's take a look over at the Dow Jones. It did not get that divergence. Why? Because it was too weak. It couldn't even make new highs. Let's take a look at the NASDAQ here. Whoa, lots of stuff happening here. A couple of things. First of all, I've got three green lines. Okay, the first one, the top one, is actually the green line showing that we just barely made a higher close on the NASDAQ. It actually made a higher close. But the other two green lines show that the on-balance volume, the purple line, and the RSI, neither one of them made new highs. So even more divergences over here in the NASDAQ, and you can see the NASDAQ has already gapped lower. So look for this market to move lower. I think probably down towards the lows that we made in mid-May for all of these indexes. So that's a pretty good move down. One good thing that is very bullish in the market, but you can see it's starting to weaken, is our seasonality indicator. And we're a long way away from turning this from bullish to bearish. We'd have to get down below 108. This is the IWM, the Russell 2000. And you can see we're a long way away from that. But once again, we've gapped lower here. So look for this over the next couple of weeks to go back and challenge those lows. And I don't think we'll break those lows, but I think we'll challenge them. Now, from StockTradersAlmanac.com, highly recommended that you subscribe. Let's take a look at seasonal patterns for the Dow since 1901, all right? Now, the first one is that black line across the bottom, and this is the 8th year of a presidential election cycle. So Obama's in his 8th year, and as you can see, this is an ugly-looking chart. Now, what it suggests is we'll be down about 14% for the whole year from the beginning of the year to the end of the year. And furthermore, you can see that we're in kind of a mildly bearish mode right now. Then we'll go into a mildly bullish mode in July, and then we'll start hitting the skids into November. But let's take a look at all presidential election years. That's that kind of blue one that's second from the top. Well, that's a completely different picture, completely different one. The purple one is no sitting president running. So that would include 4th years, all right? That's way more bullish too. That suggests a modest bull market. Now, the other thing is the incumbent party. So what this is saying is that the green line, the very bullish one, is if the Democrats win, we should see the market end up about 15% for the year. So that's the most bullish situation. And then if the Democrats lose, that would be the orangish one, which would say we'd be down a modest amount. Now, we don't know at this point, of course, which one is going to be the true case. But we need to keep in mind all of them, particularly the ones that have more data. So that would be the blue line. Now, if you look, there's a red line on there, and that's what's actually happened so far this year. So we're pretty much following the script. Now, all of these curves were down early in the year, then they rallied in March and April, and now all of these curves are in a down move until the end of May, and then an up move, which of course is exactly what's happened, but all of them except the green line suggest that we should now have a little bit of a dip. Here's the point. These charts are not telling us we're going to have a big bear market, and they're not telling us we're going to have a big bull market. They're telling us probably we're going to be for the year. for the year. That's an official Journal of Portfolio Management term. We're going to have an year. So not big moves up or down. Now that's the bad news. The good news is that this is a market of stocks. And as a result, we can still make money in a year like this. It's not like all the stocks are going up and down at the same time. No, they're diverging from each other, and that enables us to get on with the best of the best stocks and really crush this market. Yield curve, however, is presenting a bearish story. There we are there. We're basically at the high from a year ago, and then from now on, it's going to be a bearish factor. But bearish, not that we're going to see it go down. Because just because the yield curve gets flatter doesn't mean that the stock market goes down. But what it means is it doesn't go up. And of course, that confirms the seasonal picture, which is just if I can use that highly technical term from the Journal of Portfolio Finance. Okay, asset allocation. We've got a potential head and shoulders top here. This is showing that they're starting to move out of stocks and back into bonds. And we don't need much of a decline, and we'll get a head and shoulders top, which would be pretty bearish for stocks. Risk appetite also hooked down this week, so they want to be back in conservative stocks. They don't want to be in anything wild and crazy. Now, if you're a fully paid up member, then you know that I'm going to show you which sectors are bullish and which ones are not. So for all you freebies, you really ought to consider subscribing so you can get that cool analysis that I do for the fully paid up members. Global shares now this was an interesting thing. This was fantastic. I loved what was going on here. So first of all, you can see global shares got hammered. Well, a lot of it had to do, and this shows the stocks Europe 600. So this is another index of European stocks. And you can see we're down at the bottom of this trading range. So sometime this week, I'm looking for this to break those lows and signal a move down to the lows we made in February. And this is going to weigh on U.S. stocks as well. If European stocks are plunging, it's not good for U.S. stocks. I think the place to really focus is here in the FTSE. This is the Financial Times Index of UK companies, potential head and shoulders. And on June 23rd, we've got a big referendum on whether the UK is going to stay in the European Union or if there's going to be a Brexit. That's coming up on June 23rd, and that's why the market collapsed, is some polls which had been showing that the stay crowd was winning, kind of switched over to the let's bail out crowd as being ahead, and that just killed the UK stock market. So here's where we want to focus on. Greek shares, which I've been bullish on for months, also gapped lower on super heavy volume, and we now have lower lows and lower highs. So we don't want to be in Greek shares anymore. Time to get out. That's a bearish topping pattern there. Head and shoulders, gap down, lower lows, lower highs, heavy volume. You've got to get out of the Greek shares. We'll probably come back to them later, but for now, let's just take our profits and go away. Treasury bonds. We talked about this breakout, and it's just incredible. We have another gap in the marketplace, and I didn't really think we'd get too much higher, but because we broke those highs, we could easily see, just from a purely technical point of view, we could get up to 138, 139 as a first objective. So, gotta be bullish on bonds. I don't know how much further they can go, but here's the thing. 2 out of the 3 of our indicators are bullish here. 1 is bearish, which is the 10-year treasury yields over in Germany. But the CRB and gold, pretty much bullish. Not wildly bullish, so don't look for an explosive bull market here. But the market should struggle higher over the near term. Now, this is another chart that I found fascinating. I thought I'd share it with you. If we start at the top, that's the green line, which shows treasury yields in the U.S. 1.64%. 10 years, you only get 1.64%. Now, underneath that is the red line. The red line is the UK 10-year treasury yields at 123. Then we go down to the blue line. Those are German 10-year yields. And are you ready for this? 0.02%. That's right. 0.02%. In other words, you get nothing. Oh, well, that's even better than the bottom orange line, which is the Japanese interest rates for 10 years, which you have to pay pay them 14 basis points or 14 hundredths of a percent in order to own 10-year Japanese treasuries. Now, this shows the massive deflation that's going on in the world today, and that generally you can see now why the treasuries are bullish. It's because every other bond in the world is bullish. But it has another effect. This should be bullish for the US dollar. Because if you're a bond investor, where are you going to put your money? You want to earn 1.64% in the US dollar, or do you want to pay 14 basis points and own Japanese treasuries? So this should be a background bullish feature for the dollar. Here's the dollar. We're starting to see that rally. We started to rally back in early May. Then we took a little bit of a hit recently, but now we're legging back up again. At least we should get up to 95.50 on the dollar index, but I think we're going to get to 96. Breaking 96 would be important because that would get us up to 98.50. Gold, showing some pretty good strength. But I told you last week that we should rebound, and we did rebound. Now, I think what's going to happen is we're going to approach the 1300 level, but we're not going to get through it. First of all, we're in a rectangle formation, which I've drawn there. And then look down at the bottom. You can see that volume went up as the price of gold went down. But now that we have a bull market in gold, you're seeing the volume go down. That means that volume is not confirming the bull move, which is bearish, which means that this little mini bull move will not last very long. So look for gold to move a little bit higher and then start to sell off as we stay in this big trading range. However, having said that the technical picture is to use a technical term from the Journal of Portfolio Management, the fundamentals are looking pretty good for gold. So any dip is also going to be short-lived. Any dip is going to be short-lived, and we should be looking to buy gold as soon as that dip is over. So the market should go down a little bit this week, or maybe up a little bit, then down, and then we want to buy gold after the next dip. Oil, also looking very good. Nothing really to say here except wow, 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 wow. All right, everybody, thank you very much. Freebies, love having you on here. But of course, if you want to become a fully paid up member and sit with the cool kids in the school cafeteria, then you really need to be a paid up member. It's a peanut. You get super cool stock and options recommendations. Really, if you don't think you can make $47 a month, then don't subscribe. Please don't. But if you think you can make more than $47 a month, less than a Starbucks coffee every day, then go to that website up at the very top, bit.ly/weekly market forecast. All of it is case sensitive, so capital W, capital M, capital F. All right, everybody, thank you very much. All you freebies, fully paid up members, hang on. Got some deeper analysis here that I think you're going to really enjoy.